This lecture is about capital structure. I'm your professor, Dr. Stephen Haggard. Capital structure is the mix of debt and equity that firms use to finance their assets. Students are often surprised to find out how little we actually know in finance, and capital structure is a striking example. We have many theories that try to explain how much debt a firm should have in its capital structure, but none of those theories accurately predict firm behavior. Some theories will get some predictions right, others will get others right, but nobody gets it right all the time. So we are left without any good theory that will help us predict how much a firm will or should have in the way of debt in its capital structure. Now, we do know a few things, and I want to try to share some of them with you here. First of all, we know that firms with more and better collateral tend to borrow more. That makes all the sense in the world. Who would you rather loan money to? A person who could pledge their house or their car as collateral, or someone who has nothing at all that you could take in the event that they didn't pay? This is why we see these car title loan places, because those people have collateral, therefore they are able to borrow against that collateral. Riskier firms borrow less. And that makes sense too, because borrowing for a riskier firm is going to be more costly because the risk of default is higher. And because borrowing is more costly, these firms will be less likely to use debt to finance their assets. We also know that average leverage varies by industry, but is not uniform within an industry. First of all, let me make sure that I define the term leverage. Leverage simply means the amount of debt that you have in your capital structure. The more debt you have in your capital structure, the higher we say your leverage is. And what are we saying here? That for some industries, the average leverage rate is very high. For instance, banks. Banks run on around 90% debt to fund their assets. Then you get down to electric utilities, you might see 50% debt. And then get down to biotech firms and you might see 0% debt. And so we know that average leverage varies by industry, but we also know that there's quite a bit of variation within the industry. So just because the average leverage in your industry is 25%, doesn't mean that you will have 25% debt as a total of your assets in your company. Firms that seek external funding are more likely to issue stock after a run-up in stock prices, and they're more likely to issue debt after a decline in stock prices. This is consistent with the managers issuing stock when they think it's overpriced, and avoiding issuing stock when they think it is underpriced. And as you read some of the papers for this unit, you'll get an idea of how that works. Look for the term information asymmetry when you read that argument. Issuing stock tends to be bad news. How do we know? Because stock prices go down when stock gets issued. And the repurchase of stock by a company is good news. How do we know? Because stock prices tend to go up when a repurchase is announced. And finally, we know that debt levels don't really change with changing tax regimes as we would suspect that they might. Remember that interest, in the United States at least, is tax deductible. And so there is this tax advantage to debt that you don't get with equity. And as a result, if taxes are higher, we would expect companies to rely more on debt. And if taxes are lower, we would expect companies to rely less on debt. But we don't really see that. In fact, we see companies relying on debt long before the imposition of corporate income taxes. So we know taxes can't be the only rationale for companies issuing debt. What are the big questions in capital structure? We've already talked about some of these, Of course, the biggest question is, how do firms determine the amount of debt they use to finance their assets? And when we drill down into that question, we come upon ones like, what is the impact of taxes? We know that interest on debt is tax deductible, so higher taxes should lead to greater reliance on debt. And we ask ourselves, what is the impact of transactions costs? And when we talk about transactions costs here, we're talking about the cost to issue new securities. For instance, issuing new equity to pay off old debt to lower our leverage, or issuing new debt to repurchase stock to increase our leverage. What is the impact of transactions costs? If transactions costs are high enough, it might preclude firms from moving their capital structure closer to what they feel is the optimal level. And what is the impact of information asymmetry? If someone calls you up and offers you shares in an IPO, it's a pretty good idea to tell them no. They have more information than you do, and if the IPO were that great of a deal, they wouldn't have to call you at your dinner table to try to entice you to purchase. And we see that's a common reaction with shareholders. When a company says they're going to issue new shares, the first thing most investors think is, wow, managers must think these shares are overvalued. And so will that fact keep managers from issuing equity when they otherwise would? And what is the impact of agency behavior? If you think back to Jensen and Meckling 1976, they make cases for use of debt and use of equity as a remedy for some of the agency problem. Of course, we can never eliminate agency costs, but they talk about how capital structure can help restrain bad behavior. And then finally, what is the impact of the type of the assets at the firm? Consider two companies. One that has machinery that can easily be resold on the secondary market, and another whose assets consist solely of patents and copyrights, whose value is hard to know and for whom a secondary market might not be as liquid. Which one of those will likely use more debt? So these are the big questions we're trying to answer in our study of capital structure. The three papers in this unit start with Modigliani and Miller. By the way, it's almost impossible for an American to correctly pronounce Franco's name. It's Modigliani, and that GL sound is only truly correctly spoken by native Italian speakers, so don't feel bad, but just don't call him Modigliani because that's far from correct. But I digress. Modigliani and Miller, The Cost of Capital, Corporate Finance and the Theory of Investment. That's from the American Economic Review, way back in 1958. Now there have been papers on capital structure prior to that, but they tended to be normative, which means they were trying to tell managers what to do with their capital structure, and they were based on casual observations like, as long as a company maintains a moderate amount of debt, then we do not have to be concerned about default, things like that. And so it was very, very unscientific. So these folks are the first ones to come up with an attempt at a scientific explanation for capital structure. And they do a good job of letting you know as the reader that they know they haven't quite figured it all out. And that's good, because if we fast forward to 1963, we see another paper by the same pair, and you'll notice at the end of the title says, "Oh, correction." People read their 1958 paper and found an error, and they went back and wrote a correction for it. Now, in the world of scholarly publishing, this is actually pretty good if you can get an additional publication because you made an error. And the American Economic Review, of course, is a great journal to get a publication in. I wish I had one. And then finally we have Stuart Meyers, Capital Structure Puzzle. This was actually Stuart Meyers' address to the American Finance Association when he was president. And it actually comes from the speech that he made to that gathering of financial economists. And so as a result, it's actually easier to read and understand than some of the other pieces that we might read in our study of the finance literature. And he does a good job of laying out at the time what the competing theories were and what the shortfalls were of the competing theories. Now I do want to mention some things. First of all, he talks about the static trade-off theory. But what he refers to as a static trade-off theory today we would actually call the target adjustment theory, because he talks about adjusting to an optimum in a static environment. You can't make adjustments in a static environment. It's a one-period thing, and so there aren't any adjustments. So that's the first one that I would like to point out. And the second one is on page 581. I'm going to get my paper out here and tell you where I think this error is. If you look on page 581, the second paragraph, he says firms holding tangible assets in place having active second-hand markets will borrow less than firms holding specialized intangible assets or valuable growth opportunities. I think that should be more, because people with tangible assets in place with active second-hand markets, that's better collateral for lending, and so you would think that those people would borrow more. And my suspicion is confirmed if you go to page 586, about the middle of the page, the paragraph that starts in italics, borrowing against intangibles and growth opportunities. It says firms holding valuable intangible assets or growth opportunities tend to borrow less than firms holding mostly tangible assets. And so here on page 586, it squares more closely with what I think he was actually trying to say back on page 581, so be careful for that. I've also noticed in reading this that the word if is missing in a couple of places. The careful reader will notice this. The less than careful reader's mind will fill it in for that person, and they'll actually be better off for not being careful. But this is probably the only scenario in which I could say that to be true.